few months, Nitin, the credit growth in the system has been in single digits. Tell me, how much of the credit growth are you anticipating in the BFSI segment this quarter?
Yeah, hi. So yes, credit growth has been ranging between 9.5 to 10% in that range, and our estimate for the year is around 11.5. And we think that the growth will likely be back-ended, led by recovery in retail and some demand coming back in corporate. Because right now, with the bond market rates going down faster, there is some demand substitution that has happened. So we believe that with some pickup in the consumption activity, benefits from the reduced income tax rates and the borrowing cost which has come down, there will be some pickup in the demand in the second half. So which is where we think the full year growth will likely recover to 11.5 for the year.
All right, so a bit of a pickup in the credit growth is what you are expecting, Mr. Aggarwal. Morning, this is Shrishti also joining in. But in terms of the earnings, well, of course, for today, all eyes will be on Axis Bank, and even HDFC and ICICI Bank are coming with their numbers this Saturday. Help us understand that what are you expecting from these three private names? Which one do you expect will outperform the rest this time?
The quarter as such, the earnings will remain pretty soft, and we have put out a note saying that the quarter aggregate for the entire banking universe will be like a negative for the private banks in terms of YOY earnings growth. Larger banks, therein we think that ICICI Bank will be a shade better than others at 8.5% earning growth, and followed by HDFC Bank at 6% YOY earning growth. Axis, we are looking at a flattish quarter in terms of YOY earnings, given the pressure that we are factoring in respect to the credit cost, which will remain elevated. So, which is why the earnings is a little softer for Axis between the top three banks.
Indeed, but Mr. Aggarwal, of late we have seen some of these mid-sized private banks, case in point being RBL, Bandhan Bank, they are picking up. Well, of course, they had their own reasons why the stock prices were also lower, but anything that is looking good to you with respect to these particular banks or the mid-sized private banks when they are coming off their lows, how do you see the fundamentals actually shaping up?
Yeah, so there has been, yes, good activity in the mid-sized private names. Some of them have run up very well, and we also upgraded RBL Bank after the Q4 results, but the run-up certainly is way sharper than what one was looking at after Q4 results. But this is essentially driven by the normalcy in earnings, which are likely to come through from the second half of the year. So you see, like the MFI sector as a whole, has been seeing elevated stress, and it's been going on for almost a year now. And in the coming 2 quarters, the general expectation is that most of this stress will get addressed. And from second half, you will see normalized levels of credit costs, and that will begin to drive an uptick in the profitability. So for RBL, for instance, we are expecting ROAs to recover back to 1.1, 1.2 in that range by FY27. And which is why the stock essentially has done pretty well over the last quarter. And Bandhan also is on the same bucket, because as the MFI stress subsides, you will see a moderation in credit cost. They have made a good progress on deposits. The CD ratio has come down pretty sharply. And as the credit cost moderates, you will see a uptrending in their ROAs over the coming years. So the stock, which got pretty beaten down when it went down to the lows, has now seen a decent recovery from that.
Right. I want to talk about PSU banks also. Given that your report also says that they witnessed a sharper decline in the outstanding and fresh loans as opposed to what private banks have been doing and showing resilience in fresh loan yields, tell me, what trend do you foresee now?
So while going into the quarter, our view is that almost every bank will report a double-digit NIM decline from our coverage universe. But the kind of resilience that the private banks are showing in respect to the fresh loans that they are issuing is very commendable, because that in fact has resulted in the outstanding loan yield also to improve in May over April. So that's something that I think points out to that the pressures, while they will be there, but over the second half recovery will also be pretty much healthy. And to that extent, the full year NIMs will see a limited impact on margins. And that's something that we are factoring in our numbers when we say that this year we are looking at a single-digit kind of earnings, and next year in 27 we are looking at an 18% kind of earning growth for the sector. So the recovery will also be fairly healthy in margins, and I think there is a possibility that you will see some demand led growth coming back in the unsecured segments, because over the last 1 year we have seen across the board a moderation in PL and the credit card segments, and these are the spaces wherein private banks generally have been more active than PSUs. So this trajectory may start to recover from the second half, and that will further help banks limit the NIM impact arising from this loan repricing that they are having right now.
So NIMs, but what about slippages? Because many analysts are expecting an increase in slippages this time around for the entire banking space. Or what could be the reason behind this, and how much of a hit could it lead to for the profitability this time around?
I think slippages, while there could be marginal increase, and therefore even for the credit costs, we are building in some bit increase, but it will still be fairly controlled. If you look at the broader lending segments, there is some bit of stress which is still remaining in the unsecured loans. So MFI, as I said, is one segment wherein the slippages will remain elevated in the coming 1 or 2 more quarters. And alongside, you are also watchful of personal loans as a segment. So, and that's the reason the slippages, while it may be a tad higher, but within FY26, we will be more watchful in first half than the second half on the slippages. The other lending segments, be it corporate and SME, they are still going fairly healthy, and we are not expecting any major changes or deviations in the slippage trajectory there as such. So I think for the system as a whole, credit cost will remain more controlled for underlying some banks who are more exposed to MFI. You may see elevated levels continuing, but for the larger banks, I think credit cost will still be like fairly well in control over the year.
Then with this, we let you go on that. Thank you so much for taking the time out and speaking with us and helping us understand that what could be in the store with respect to the earnings of the BFSI space. But with this, let's move on, and let's also welcome on board Shivani Sarkar Korean, who is joining us on the show right now. She's a Senior Executive Vice President and Fund Manager and Head of Equity Research at Kotak Mahindra AMC.